Welcome back. This is the episode 9 of the Fostering Financial Victories podcast. So today I am joined by Caleb LeGrand and Garrett Hyer, and we're going to talk about what is arguably one of the most expensive purchases that most people will ever make in their life. And they might make it a couple times. So I want to give you a little bit of background on these two folks, and let's let these guys get into this conversation. So Caleb has 14 years of experience in the mortgage world, previously worked with Deloitte and Dixon Hughes in the accounting side of things. And then Garrett joined our team as a wealth coach back in 2017, and his expertise level has now risen to where he is the resident expert on business transactions inside of our office. So really two unique discussion points here with what's going on in the current market and then kind of the whole mortgage discussion in general. So Caleb, thanks for joining us. I know you are very busy right now. I appreciate you taking some time.
Yes, sir. Happy to.
So tell us a little bit about how you got from the accounting side of the financial world to the mortgage side of things.
So it really happened by accident. So when I bought my first house 22 years ago, we went into a mortgage banker and got a loan. And at the time, I was a little disenfranchised with the accounting world. There's nothing wrong with it, but it wasn't able to actively impact clients' lives as fast as I wanted to. So you start out, you're just doing kind of the work behind the scenes. So he said, you're looking for a job. And I said, well, are you hiring? And literally that was 14 years ago, started doing it on a part-time basis for a year to transition out of accounting and haven't looked back yet. So, and I really love what I do. It's a lot of fun.
Well, I've heard you say it a few times in passing, you have the greatest job in the world.
I do. I get to lend money, so nobody ever says no. So unfortunately, that's what we have to do.
Very cool. All right, so a little bit of an update on kind of what's going on. So we are sitting here, it is April the 9th. There's been a lot of turmoil, if you want to say, from the economic world, maybe a little bit. But on the mortgage side, you guys were on fire right out of the gate with this. So kind of what are you seeing right now?
So first quarter was extremely strong starting off. Originations were truly at all-time peaks. I would say in the most recent 30 days here, as we've moved into a lot of state shutdowns and things of that nature, we're probably running about 60% capacity of where we would normally be this time of year. A lot of purchase decisions are being deferred or defrayed until things sort of clear up. The other biggest challenge we have right now is with all of the furloughs taking place as employers and plants shut down. Unfortunately, that client's ineligible for financing. So just in the most recent 2 weeks, we've had over 15 transactions that have fallen apart, just virtually because, okay, this one got put on furlough, so that impacts this transaction, that impacts this transaction. So it's kind of a hurry up and wait mode at the moment. I do think it's short-lived. I do think that we'll see a lot of this dissipate hopefully in the next 60 to 90 days. It will be interesting to see what it looks like on the other side of this, though.
From there, Caleb, I think speaking very macro level, what do you see specific to the Greenville market in regards to the mortgage environment that may not be something nationwide? I know we have a very unique market here. And
we've been extremely blessed here because we're one of the few areas that we're getting both ends of the demographic scale. So if you look in a traditional housing market, it's usually either you have a lot of transient population coming through for jobs. So I'll use like Washington, D.C. as an example. There's not a lot of natives, and there's not a lot of people that retire to Washington, D.C.
Yeah.
So they're highly transient because they're coming and going for jobs. Then you have, like, say, in Arizona or Scottsdale, where you have a lot of people who move there to retire. So we're very fortunate. We see both ends of that here. So we have a lot of clients that are moving from down south in Florida or coming down from up north where there's a much higher tax rate for property taxes, higher state level taxes. So they're coming here to the upstate because we're kind of that happy medium. You can have mountains, rivers, lakes, all of that within a 4-hour drive. Very affordable cost of living. We still, I think the last time I looked at it, we ranked number 44 in the nation from an affordability standpoint. So those retirees, those baby boomers are coming here and buying housing, which is awesome. But then we also have a very strong demographic of younger clientele because we have a very good economy. And that's going to still remain because if you look, most of the companies in the upstate had very strong balance sheets or cash in the bank moving into this. They're in industries that while they'll take a hit, they will still probably come out of this okay. And so you've got both of those things moving into our market, which just simply helps support housing because it's all about demand.
Yeah, that brings up a great topic. So the demand on houses, I mean, for the last year, the running joke has been,
if you like it, buy it. It's like Costco.
Yeah,
it's going to be gone tomorrow.
Yeah. So, I mean, are you seeing, I would think you're seeing a little bit of a trend change there or not?
Not as much as you might think. So if you look, what was different this time around compared to, say, 2008, 2010, which would be the most recent crisis like what we're seeing here, there is not a glut or oversupply. So builders just literally last year reached the point where they were simply building enough houses to meet the current level of demand. Prior to that, we were under the demand level to keep up with housing formation by anywhere between 10 to 20%, depending upon the year you look at. So we went into this with, we're barely covering people's demand. So the higher end, so 250 and above, we've seen that fall off pretty dramatically in the last 30 days. Here today is April 9th. And that makes sense. Those are the more affluent clients.
Sure.
They have a lot more stock market exposures. So a lot of those clients saw a lot of wealth impact.
Yep.
They're also going to be more affluent and higher up the management chain, which is also more susceptible to being laid off, because if you're trying to trim overhead, well, we get rid of this one guy, that takes a big haircut. So the 250 and below price point is actually still very brisk. Just as recently as this past weekend, we had 4 or 5 clients making offers, and they were still multiple offer scenarios. So good houses, priced well, good location, you're going to see it move. And if you're in that 250 and below price point, I don't think you'll see a huge fall off or impact. I think those prices will remain flat. I think 250 and above, you'll see a little bit of softness, which we were already starting to see that moving into this pre-March. And that's just because that's that more affluent client, and that market wasn't moving as fast.
Makes sense.
Caleb, you mentioned 2008, 2010, kind of the last mortgage-based crisis event. I think something probably none of us were even thinking 60 days ago, but the term forbearance or how do I potentially hit pause? Do you have any thoughts or commentary on that?
Yeah, I'll start off with make your payment if you can, please. The strategic forbearance is a horrible idea. So the forbearance package, there was a little bit of irresponsibility on Congress's part, and you got to give them some grace, because they're trying to address a massive, massive crisis of something we've never seen. If you look at all previous recessions, all of them had bright spots in the economy. This is one of the first times where you go, throw a rock. Virtually everyone is shut down or undercapacitized in some fashion. So they just went, screw it. We're going to pay money out. We're going to flood the market with cash. Let's get this thing back on. The issue is there's a moral hazard created because there's no burden of proof on a mortgage payer to say, hey, I had a financial difficulty. Any one of us at the table can call our mortgage servicer or the person collecting the payment today and say, I don't want to make my payment for the next 6 months. They have to delay your payment, no questions asked. So I would strongly counsel to, for you as the audience and then for you and your clients, please don't use it unless you need it, because it will have a negative impact. You're going to be tacking cost on the end of your loan. Some of these are going to be interest-free loans, some of them aren't, so you're deferring payments. It's not free, it's just kicking the can down the road, so to speak. And if you genuinely don't need it, taking that forbearance is only going to exacerbate this problem. Because the way the mortgage industry works, I as a lender, I still have to send that payment that was due to the end investor behind the scenes, whether that be a sovereign fund in Dubai or China or whatever. Those people want their money, and my covenants say, I'm sending you your money.
Yeah.
So it's the equivalent of, hey, I'm not going to pay for 6 months, and you still have to send the payment in. So you can imagine just the raw panic that's being created in the market of, holy cow, we knew that on average there's a 3-ish% default rate on loans. Everybody's capitalized for that. We're not capitalized for, the last number as of last week was 28% of loans are being requested to go into forbearance. So that is just an insane number. That doesn't mean they're all getting approved, but all the servicers are being overwhelmed. So that amount of cash being sucked out of everybody's bank account from a lender standpoint is just insane. So please, please, please make your payment if you can. And if you're without income, that's what it's there for. Take advantage of it. The key is to protect your household and your finances and get your feet back underneath you. But if you have the wherewithal, please make that payment. It will help things. You'll be doing your part for the American economy by just keep doing what you're doing.
If you do elect a forbearance, what are some of the things that could happen down the road that may impact you, what we don't see on the horizon immediately?
So a lot of it is still squishy, because you have to remember this has just been put in place, as of today, about a week ago. So it depends on who holds your loan. Is it Fannie Mae? Is it Freddie Mac? That would traditionally be a conventional loan. Or is it FHA, VA, or USDA? What the government-sponsored entities, which is what those will be known as, will do is somewhere between a 6 to 12 month deferment, and by and large, most of that is being tacked on to the back end of your loan. Meaning, for easy math, if you owe $100,000 a day and your monthly payment's $1,000, and we defer the payment for 6 months, they're going to add $6,000 on the back end of your loan. So you're impacting your future equity. Those, by and large, for the moment, will be interest-free, so at least you're not accruing interest on interest. but you're deferring future equity. The impact to credit, it's not supposed to be reported as a negative, but as someone who was practicing through 08 and 10, I can tell you that's not going to not be the case. So lenders are not in the business of doing this for free, and they're also not in the business of just trying to be kind. So they're going to say, once we get past this, if you had a forbearance, what we saw from 08 and 010 was if there was a forbearance and a modification of your mortgage, which is what that would be, you were not eligible for new financing oftentimes until 12 or 24 months had passed from that. None of those guidelines are out as of today, so there's no way to say what that would look like in the future. But for the moment, you're at risk of potentially not being able to qualify for a new mortgage down the road. You're going to have a higher cost whenever you go to sell the home, and if it's not one of the government-sponsored entity loans, most of those programs are you're just kicking the can down the road for 90 days, and then they want the entire 90-day payment at that time. So if you're already in financial difficulty,
It's not going to help you.
stacking up $3,000 that's due in 90 days is not a great idea. So I would say just really exercise it with caution, and please try not to use it unless you are genuinely in a cash flow crunch where if you're unemployed or there's not money coming in, then yeah, take advantage of it. But if you're gainfully employed and your situation hasn't really changed, you would be wise to continue to make your payment because you're not going to really benefit. It's not like you're going to get some secret benefit for kicking your can out 6 months.
There's no such thing as free lunch, right?
Yeah.
Definitely not in this case. And like I said, as people grapple with this from the lending industry, you know, they're going to probably have a little bit of resentment for, I had to make your mortgage payment for 6 months and you didn't have to. So yeah, when the next time comes around, I'm going to remember that.
Yeah. So those things are not being said. Yeah. And that's good for people to hear, I think, because there's always another element to the story.
And like I said, you know, this is very new right now, so that could change. I mean, there could be congressional law put in place that disallows some of that, but it's really the Wild West right now. I mean, you have people running around like their heads on fire going, in 30 days, all my cash is going to be gone as a lender.
Yeah.
What are we going to do about that,
right.
Congress or government? And they're actively working, Treasury and Congress are actively working to stand up some form of a credit facility, but I'm not sure even they realize the full implications of what they've put out so far.
I mean, 28%.
Is a stupid number.
That's massive. When you said
and
3%,
that's round
normal.
one. So I mean, you got to understand, there's still a ton of people. Like if you look, unemployment, you know, was roughly like what 4 or 5 million last week. Initial claims today was 6.6, only 6.6. That's going to continue to show up as more and more people went on unemployment or furlough status here in the last week, 2 weeks. So all of those folks who had not yet called in for deferment are going to start to call in for deferment or forbearance, which is just going to further compound the problem.
Yeah. It could be well above 30% before we even turn
The
around.
high number projected was somewhere in the 40 to 45% range. So I mean, if you think of, you know, we got 10 mortgages made and 5 of them may not pay, that blows out all risk parameters, all models. Nobody's prepared for that.
Okay. All right. So when people are going through the mortgage decision and kind of what to do, there are a lot of questions that come up.
Sure.
As far as how do you even do this, especially the first-time home buyer or somebody who, you know, maybe they weren't involved very heavily in the purchase of the first house, but maybe the second one they're intimately involved in it. What's some of the most common things that people ask you about? What do they need to be aware of when they start that mortgage discussion, and kind of what should they be looking out for?
I think first and foremost, understand that your mortgage financing, and I don't say this since this is what I do for a living, your mortgage financing is going to be what really drives that decision, because the two most common questions right off the bat are, what's my payment and what's my cash to close? Well, that's not necessarily driven through the real estate side or the realtor side. That has to do with financing. So I would recommend someone starting out talk to a mortgage lender, whether it's myself or someone who does what I do for a living, to get an idea what your financial picture looks like. And the thing I really enjoy the most about what I do is we're taking your largest indebtedness. I mean, for virtually every household in America, your mortgage is your largest debt. So if we properly structure that, weaving that into your overall financial picture, everything spins off of that. Cash flow, long-term financial decisions, college for kids, future retirement. So making a wise decision on that mortgage, whether it be putting more down, less down, 30-year, 15-year, do we take an adjustable rate, do we look at a fixed loan? All of those variables are truly going to be unique to your personal profile. So it's a matter of sitting down with someone who has that skill set, financial advisors and mortgage planners to go, how do we best weave this in? And then the biggest misnomer is, of course, everyone thinks they have to have 20% down.
That was what we were going to ask.
There,
So what do you
there
do?
Are, there are a multitude of programs that would allow you to purchase a house with far less money down, and many times we'll encourage a client to explore that. So typical use case for our market would be client moving from up north, sold a house for $600,000-$700,000. They're coming down here with between $200,000 to $300,000 worth of equity that they're planning on rolling over, and they're looking at a $300,000 or $400,000 house. Conventional wisdom from years past would say, well, I'm going to buy a $400,000 house, I'm going to put $200,000 down, I'm going to finance the remaining $200,000. What you have to clearly understand is on a house, the dollar invested in the home does not make the house worth any more or any less. It's worth what it's worth. It has value apart from the mortgage. So then it's just simple math. Let's just say, rates on average today are 3.25. So if I have $1, I put it in my house, I make or save 3.25%. If I could give that dollar to some really smart financial people like the two I'm sitting beside here, it's last number I heard, on average 45 years index for inflation, the S&P 500 is going to return about 7.2%.
Yeah.
So if I put $1 away at 7.2 versus 3.25,
Which one's
it's
better?
not rocket science. And so that's where looking at properly structured loans with a lower down payment and either paying off other consumer debt so that you clean off all the other debt on your balance sheet, and then you can then prepay the mortgage. So we've had clients that came in and they've had $30,000 worth of credit card or automobile debt and said, look, let's restructure this. Let's take that $30,000, let's pay off all that other household debt. The cash that's freed up from that can then be applied back against the mortgage. And they could do a 15-year note.
Right.
Just simply by rearranging things on the balance sheet or investing it, and at the end of the time frame, if we do a 30-year loan, the house is still paid for. The house is paid off in 30 years no matter what, but that money growing in an outside investment account would be worth probably a 3-time multiple of what it otherwise would have been in the house, so their net worth or their nut of cash is dramatically larger than it otherwise would have been. So each situation is going to be unique, but would highly recommend you take time as a consumer to invest in figuring out what's the best thing for your personal finances. And you don't have to be a magician to go know every aspect of the market. That's what we're here as professionals for. And just ask questions. If you don't understand it, ask.
So when does it make sense for somebody to use some of these 0% down programs?
Oftentimes if they qualify for it, it makes tremendous sense.
Okay.
So like VA loans are a tremendous benefit. So you don't have any monthly mortgage insurance. It offers you 100% financing, and the rates typically are a little bit better than what you see on a conventional loan. So qualified veterans should very strongly look at, does it make sense to tie up the money in the house? I can tell you that right now you're only saving about 50 to 60 cents on the dollar, meaning for every dollar you invest in the home, you're only going to get back about 55 cents of that in terms of interest expense savings. So if we look at it like we do any investment, if I came to you and I said, Erik and Garrett, I got a great investment, give me $10,000 today, and in 30 years I'll give you back $5,500, you're probably not going to be very excited about it. And that's precisely what you're doing with loans. So most of that conventional wisdom came out of an era where interest rates, even today, if you look at the 45-year average on a 30-year note, it's 7.5%. Well, at that level, pay the dang thing off.
Right.
Yeah.
But when we get down into the low threes, it just doesn't make a lot of sense. So I would leverage the house to the extent that you're comfortable and not overextending yourself, because as we've all learned here just in the last 30 days, cash is king.
Yep.
Not being over leveraged so that you can weather these type of economic events is very important. And so there's always a balance between let's finance the whole thing to let's pay it off. So you want to find that happy medium.
So let's say we're a client that, or any listener that's hearing this that maybe didn't take that approach, didn't have sound financial counseling up front. Given the current interest rate market, is it an opportunity when you refinance to then go through that process and look at overall cash flows and take that more comprehensive approach that you speak to?
Absolutely, and it's basically a way to reboot and do a do-over. So I mean, rates at the beginning of March touched their all-time low in the country. I mean, we touched for literally about 48 hours a 3% rate. And then the mortgage market fell apart. We went all the way back up to 4%, and we've been bouncing around in between there. So clients that are anywhere between 3.75 or higher will have an opportunity to explore that this year specifically. Maybe not in the next immediate 30, 60 days, because we got to work through all the forbearance stuff and all that hot mess. But rates will be lower. I mean, if we had stripped away what's happened, rates should be about 2 3/4 right now from just an actual market pricing standpoint. You have all the dynamics going into it of we don't know what's going to happen, so when we're not sure what's going to happen, we're just going to raise prices because that's safe.
Yeah.
So I would say, looking at that in third and fourth quarter, from a cash out standpoint, if it makes economic sense to clean up other debt, pull that money back out. Maybe you did a 15-year note and you're going, you know what, I don't think I want to keep paying this high payment. Converting back into a 30 just to slow down cash flow, taking advantage of other outside investment opportunities. It's an easy time to do a reboot and a do-over, assuming you're gainfully employed or have good income and assets and all that fun stuff.
So if somebody's looking to do that, what could they expect from a cost perspective on a normal refinance? What's it based on?
$1 million. No. So, your costs by and large are flat fixed fees.
Okay.
So, really the only variable in a loan typically is going to be whether you're paying points. And people make a bigger deal out of points than they really should. All points is prepaid interest expense for the right to have a lower rate over the life of the loan. And right now it doesn't make a lot of sense because you're not getting a lot of a pickup for that. Mm-hmm. But other than that, most lender fees are fairly flat fixed fees. The appraisal fee is a flat fixed fee, and the attorney fees are flat fixed fees. So it'll scale somewhere between $3,800 to $4,300 on average.
Okay.
That doesn't include your escrow, so keep in mind that we'll have to potentially set back up taxes and insurance. So there will still be those costs, but that can all be rolled back into the loan. And there's no free lunch. So I've seen a lot of online lenders advertising no closing costs. Well, you need to ask them, are there no costs I'm paying, or are they just being rolled back into the loan?
Yeah.
My own brother and sister-in-law called me, and I won't name who sent it to them. They're like, oh, they said no cost. Great. So you're saying your loan balance is equal to the new one? No, it's like $7,000 higher. So where do you think that money went? Aha!
The light bulb moment.
That's where, and it was still a good overall offer.
Yeah.
But it's just, there's unfortunately a lot of confusion because it's just like taxes. People don't do this every day. Average consumers can do this 3 to 5 times in their entire life. And the last time they did it may have been a few years ago. Mm-hmm. So it's just making sure you can talk to somebody you trust, and getting a good referral from a financial advisor or family member is a wise way to go about that, because you all have their vested interests at heart, and being that quarterback in that financial plan can help them make smart decisions on what's next.
Kind of thinking through just the piggybacking off that and maybe taking some stuff one step further. We get a lot of people that you mentioned coming into the area, don't know how long they're staying, or maybe say, hey, this is a first move into the area, I don't know the area that well. Can you talk a little bit about the rent versus buy dynamic, and when you get that question, and maybe the advice you'd provide?
If you're not sure where you're going to be, I would advise a client to rent. And the reason for that is our market's not typically a hyper appreciating market. If you look on average, we will appreciate somewhere between 3.8 to 4.2% on average. Now, the last several years have been a bit of an outlier. There's areas that have gone up as much as 8%, but you're basically saying if I buy a house, I'm only going to hold it 2 or 3 years. That's pretty much a break-even proposition in our market. And that limits some of your options if there's another opportunity that came up to either buy a house, move for another job, or things like that. So if your holding period's only 12 to 36 months, I would strongly counsel looking at maybe just renting, getting acclimated to the area, and then making your purchasing decision.
Yeah.
Buying a house is still, in my opinion, no offense to our advisors here, I think one of the best and greatest wealth generators that you can have.
Sure.
It's the perfect hedge against inflation. You're paying for it with tomorrow's dollars borrowed and today's dollars, and theoretically, it goes up in value most times.
Yeah, I think that's the question we get a lot of times, especially with folks who maybe they have a temporary job placement here in town, and they're going to be here for 3 or 4 years. They've always heard you got to buy a house, don't pay the high rent. But in reality, what it sounds like you're saying is that 3 years, 4 years is kind of that break even to where you just pay the cost of buying the house.
Yeah.
The only time I would say, and every client's situation is different, but where I would say that may make economic sense. And when we had a client, I believe it was one of yours, it's kind of that situation. He was here for a temporary position, it's going to have a 3-year window, and then they were probably leaving. So the conversation we had with him was, if your exit strategy is to keep that as a long-term rental, that makes a lot of sense, because you can buy that property as a primary residence with much more favorable terms from a financing standpoint than we would be able to give you otherwise. And then now you've got something that you can put into that overall portfolio, pouring into your bathtub of wealth, that'll hopefully generate rental income. So there's nothing wrong with that as an exit strategy. Say, I'm going to live in it for 2 or 3 years, and then I'm going to rent it out when I exit. That is a scenario that can make a lot of sense. But if it's truly, I'm going to live in it for 2 or 3 years, and I'm going to exit, then you make your money when you buy in real estate. Despite what anybody might tell you, you know what you're going to make, because you're going to be able to determine that by the time you purchase it.
Sure.
So if that's your plan, you have to get it at a pretty significant discount to justify the cost of owning a home. Otherwise, just rent. and enjoy the freedom of not having to worry about upkeep on a house and selling it when the time comes. It just allows you to be very flexible when that exit strategy pops up.
So you mentioned the rental side of this a little bit, and kind of a segue into this next question is going to be the financing for rental properties. So Greenville, there's a lot of people running around who want to buy rental properties, right? We hear it almost on a daily basis. I'm sure you do as well. While there's nothing wrong with that strategy, tell a little bit about the differences on the financing piece of somebody when they want to go buy a true rental property from the outset versus taking a personally owned property and turning it into a rental.
So the primary differences is going to be it's going to take some cash. So the old 06, 08 era of you can buy a house, no money down and rent it out. Yeah, that's gone.
Yeah.
So on average, it's going to take between 20 to 30% down, and it depends on if it's a single family, like a single house, or what's called multifamily, which would be like a duplex, which is 2 units, triplex is 3, and quad is 4. So you can go up to 4 from a rental standpoint in residential marketing. When you move beyond 4 units, you move into a commercial one, which I don't do, so I'm not going to speak to that. So the main thing there would be you're going to have a fairly substantial down payment. And please don't go into this thinking, well, I'm going to spread $100 a month in profit, and this is a great investment. That is a horrible investment. You will lose money, and you will be a very bad landlord. So you really have to go into it with you will need to have a minimum, and I mean an absolute minimum of about $300 a month positive cash flow after everything, because it all gets eaten up. The first time you got to replace an HVAC, well, there's $5,000 gone, or the roof has to be replaced, or your tenant flushed something down the toilet they absolutely shouldn't have, and now all of a sudden everything's backed up and ruined. In order to be a good landlord and attract good tenants that will give you good market rents and stay, you have to be able to administer and address those things. So you need to go into it with a minimum of a $300 a month positive cash flow with the expectation that, okay, I'm going to give some of this away every year as I make repairs and things of that nature.
So I've got to have the cash to bring to purchase the property. What are the interest rate differences going to look like versus me?
They're going to be about a 1 to 1.5% higher. And in an investment property, so on a residential primary residence, the down payment really doesn't impact your interest rate that much. That's one of the other myths. So everybody thinks, put down 50%, you're going to give me a great rate. No, I mean, the guy who's buying it behind the scenes doesn't care what your down payment is. He cares about the income stream. On an investment property, that's not true, because the larger the down payment, the more the risk is lowered. And so an additional 5% down can drop that rate as much as 0.5%. So that's where you want to really look at the financing aspect of it to go, does a larger down payment make sense? Balancing that with the proper leverage of the goal of investment property should be, I can buy something where I get a cash flow stream or money coming in, like a dividend on a stock, for a smaller cash outlay than having to pay cash for the entire house.
What about from a tax perspective? I know that's a lot, especially in South Carolina. It's not the case in every state, but quite a unique situation when you go into the rental side of the property tax piece here.
It's a big difference. And so we've got the 6% non-owner occupant rate, which is what investment properties are, and we have the 4% owner occupant rate. And everybody thinks, 2% is not that big of a deal. They're right. What they miss is you also give up the school tax credit. So if we just look at a $200,000 house, taxes, depending on where you're at, because we've got 26 different millage rates, taxes on a $200,000 house are going to be about $1,500 for a primary residence. If we flip that over to an investment property, depending on where, it can be anywhere between $3,800 to $5,200. And so you have to really pay attention when you're looking at your math, because a lot of folks go, well, I pay $1,500 in taxes, payment should be about this. You have to account for that when you're looking at your cash flow. And then, just be prepared. They're going to charge you more.
You could all of a sudden be upside down on this cash flow thing.
We've seen clients that have a primary residence when they go to look to convert it into a rental property that didn't properly account for that, and they're going like, I'm going to make $200. Actually, you're going to have to pay in a $300 each month when we get done with this tax adjustment thing.
You just subsidize it.
Wait a minute.
Don't want to do that.
That's not cool.
Yeah. Okay. Yeah. So I think with South Carolina in particular, it's not in every state, but it is unique to this state.
It is unique to the state, and it's something you want to be aware of. That's one of those things. There should be no emotion involved in buying an investment property. It's just math.
Yeah.
So make sure you run the math up front, and then however you want to put your model together for buying it, which is I want to have $100 a month, or I want to have $200 a month, or I want to have $300 a month. Once you know the math, and that will help you decide what you're going to be able to offer on the property.
Makes sense. Good. Good.
Yeah.
All right. So the last thing that I had is, much like the investing world, right? So you mentioned the emotion side of when you buy a rental property and that. When do you sell it? When do you finally say, you know what, I'm cashing out, it's been a good ride, I want to move on?
That's a difficult question to answer with any real rules of thumb, because it's just like somebody coming to you and saying, hey, I bought Apple stock at $100 and it's $1,000 now. Should I sell it or should I ride it or what should I do? It really depends on that client's goals at that time. The challenge of a rental property compared to, say, a stock. Your stock doesn't call you at 3 a.m. in the morning and say, my toilet's backed up. I need you to come out and fix it. So I would always counsel a client, if you're only making a 7 or 8% return on that investment property, unless you're going to make a lot of money by the value of the house going up, you should really think hard about getting rid of it, because you're taking on a lot of additional work and a lot of additional risk for a very small rate of return. You can go buy stocks, bonds, gold, Bitcoin if you're crazy, whatever you want, and get a similar rate of return without the investment of effort.
Without the phone call?
Without the phone call, without the upkeep, without the heartache, and oh my gosh, they moved out on me, now I got to cover this payment. So I would say if you're going to buy rental property, you really need to be shooting for a 10 to 20% rate of return. And then from an exit strategy, it's just a matter of, are you tired of keeping up with it?
Yeah.
Do you have better opportunities? You just want the money back. I mean, I've personally bought and sold property, and some of my decisions was based upon, I need the cash. So sold some rental property to raise the cash for other opportunities and kept the rest of the portfolio. So it's just like any investment, depends on your set of circumstances and what your criteria would be. And I would strongly recommend you get counsel on that, whether it be your financial advisor or really your tax advisor would be the biggest one on that, because there's a lot of tax implications on the sale of investment property that do not show up in the residential primary residence world. You got to be super careful. You might have started out with a profit, but by the time you pay back depreciation, recapture, and everything else, you're like, oh, wow.
Yeah, what a good idea.
What? That was not smart. My money's gone.
Not a good decision.
Yeah.
All right, so let's stop it here. I know you got a lot to get going on today. We got a couple questions that we want to ask you. I think we gave you a little bit of a precursor. So these are questions we've asked every guest we've had on the show. First one is, biggest financial mistake you learned the hard way?
The biggest financial mistake I learned the hard way was being too cocky and thinking that I knew everything about everything. And this was thankfully in my younger years. As I've gotten older and hopefully a little wiser and grayer, you come to realize how little you know. So there was a couple times in my life where, like, I got this, and I'm not going to make any mistakes. So, I mean, I can distinctly remember in December 2012 was buying and selling options and had done really well up until that point, and ended up being wrong on the timing, and it cost me over $35,000 in a single month. That cured me really fast. I'm going like, okay, just because you think you know something, you may or not, and you got to be careful of the amount of risk, because that was money I could not afford to lose at that time. And so that cured me of, if it's an investment, it needs to be an investment. And then also making sure that whatever you think could happen, probably multiply it by a factor of at least, another 50% or even 100%. I mean, look right now. If you had looked at somebody first quarter, man, we're doing awesome.
Yeah.
And literally 30 days later, half the world's unemployed, everything's shut down, and people are burning through cash like it's going out of style. So getting to a point where you have sufficient reserves. I've made the mistake in years past where what I thought was enough was not enough because perfect storms hit, and it's just like, holy cow. Yeah, so surviving that will allow you to be stronger on the other side, of just knowing a little more wisdom of, okay, there's a lot of prudence in listening to others that have gone through this. So that's one of the things I took from it. Was I'm just going to ask a lot more questions and not assume I know as much as I think I know.
Yeah. All right. Second one is, if you could buy anything in the world, regardless of what it costs, what would it be?
For me, it would be a lake house on Kiwi with all the skiing equipment to go with it, because I love to water ski. We grew up as a family doing that, and that's one of my happy times. So if money was not an object and I had no other responsibilities,
that would be it.
I would buy a lake house on Kiwi with all of the accoutrements to go with it and just tell the world bye.
All right. And last two things you spent money on.
Well, I mean, we joked about this, but this is true. It's probably hand sanitizer and toilet paper. But the last two non-consumer staple good purchases that I made, I bought a television because my other one broke, so it was time to replace it. That was really about it. I mean, I haven't spent a lot of money on anything in the moment. We've just been busy working.
Hand sanitizer.
Hand sanitizer.
Hand sanitizer.
And that's worth like $400 more now. So
no doubt. I mean, maybe that's the investment.
That's the investment.
On that,
that's where I made mistakes. Like, should have gone to Costco and bought all that stuff before this.
All right, so from an accountability check with this episode, so there's one thing we would ask you to maybe take some time and do after you listen to this, would be to familiarize yourself with the current terms of your mortgage if you have one. If you have questions on it, maybe you reach out to somebody and get some clarity around that. Caleb, if you could, tell these folks who are listening and watching where they can find you if they want to reach out and ask more questions or get in touch with your team.
Yeah, so the easiest thing, you can always call us. So we love to talk to clients. We're very straightforward, and I think both of you can attest. There's oftentimes we just say, hey, don't do anything. You're in great shape. You don't need to touch this. So you can call the office at 864-569-0741. You'll get either myself or my partner, Melissa, to begin that conversation. You can also find us online. It's just www.clteam, so Charlie Lima Team.us. Since we've got some resources online that a client can look at, happy to have a conversation. I mean, I'm a firm believer in, no pressure. If it doesn't make sense, it doesn't make sense, just like your all's practice.
Yeah. Mm-hmm. Well, thanks for coming in. Guys, you can find us, if you want to follow us on Instagram, Foster Victor Wealth Advisors is the tag there. And then you can go to our website if you have questions or comments or suggestions on any topics that you would like for us to cover, or if you want to get in touch with us and ask more details about a personalized situation here. Our website is fostervictorwa.com. Again, thanks for spending time with us. Please forward this and share it with as many people as you can who might find it interesting. Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.